Most people think markets are driven by millions of independent investors. That belief is outdated. Today, a small number of institutions sit at the center of global ownership, not because they trade aggressively, but because they own everything quietly. Two firms in particular dominate the structure, and they don't run countries. They don't pass laws. They rarely appear in headlines. Yet together, Vanguard and BlackRock are the largest shareholders in most major corporations on Earth. This is not a story about conspiracy. It's a story about how modern capitalism reorganized itself, and how ownership, power, and control shifted in ways most people never noticed. For most of the 20th century, markets were shaped by individual investors, family offices, active fund managers, banks, and insurers. Ownership was fragmented. Control was noisy. The shift toward concentrated ownership is not unprecedented. In the late 19th and early 20th centuries, economic power was concentrated in industrial trusts, railroads, steel, oil, and banking empires. Ownership was centralized but visible. Power had names, buildings, and public faces. Standard Oil, U.S. Steel, and J.P. Morgan's banking syndicates were obvious centers of control. Their dominance triggered political backlash, antitrust laws, and public scrutiny. The modern system is different. Ownership today is diffuse in appearance, but concentrated in function. Power no longer sits in operating companies, but in the institutions that own shares across all of them simultaneously. Unlike the industrial trusts, Vanguard and BlackRock do not dominate a single sector. They span every sector. That makes their influence harder to see and harder to regulate. The shift from industrial monopolies to ownership concentration represents a quieter, more abstract form of power that changed with the rise of institutional investing, pension funds, endowments, sovereign wealth funds, retirement accounts. As populations aged and retirement systems expanded, trillions of dollars needed to be invested passively, cheaply, and at scale. This demand created a new kind of financial power broker, the asset manager, not a trader, not a bank, but a steward of other people's capital. Vanguard's story begins not with power, but with a rebellion against Wall Street itself. In 1975, John Bogle founded Vanguard with a radical idea for the time. Investors should not try to beat the market. They should own it. At the time, active fund managers dominated the industry, charging high fees while often underperforming the market. Bogle argued that fees, not market timing, were the biggest drag on the long-term returns. His solution was simple but revolutionary. The first retail index mutual fund, tracking the S&P 500. The financial industry mocked it. Critics called it Bogle's folly. But over time, the math proved undeniable. Lower fees compounded into higher returns. Vanguard's unique structure amplified this effect. Unlike traditional asset managers, Vanguard is owned by its funds, which are owned by investors. There are no external shareholders demanding profit maximization. As assets grew, fees fell further. This feedback loop, scale driving lower costs, which drove more scale, became Vanguard's defining advantage. By the early 2000s, Vanguard had become the dominant force in passive investing. By the 2020s, it became one of the largest owners of corporate America. BlackRock's rise followed a very different path. Founded in 1988 by Larry Fink and a small team of former Wall Street executives, BlackRock began not as an index giant, but as a risk management firm. Its early focus was fixed income, bonds, mortgages, and credit instruments. This focus turned out to be critical. After suffering losses exceeding $100 million at First Boston in the 1980s, Fink became intensely focused on understanding risk, correlations, and balance sheet exposure. That obsession gave birth to Aladdin, a proprietary risk analytics platform designed to monitor portfolios in real time. While Vanguard scaled through low fees, BlackRock scaled through technology, advisory relationships, and institutional trust. The 2008 financial crisis marked BlackRock's inflection point. As banks collapsed and markets froze, governments turned to BlackRock for help valuing toxic assets and designing rescue programs. BlackRock did not just survive the crisis. It emerged as a central node in the global financial system. The phrase owns everything is often misunderstood. Vanguard and BlackRock do not control companies outright, but their scale makes them unavoidable. As of the mid-2020s, Vanguard manages over $8 trillion in assets. BlackRock manages over $9 trillion in assets. Combined, they oversee capital larger than the GDP of every country except the US and China. Together, they are top shareholders in Apple, Microsoft, Amazon, Alphabet, Meta. Major owners of J.P. Morgan, Goldman Sachs, Bank of America. Significant holders of energy, defense, and industrial firms. Studies show that Vanguard and BlackRock are among the top shareholders in approximately 90% of S&P 500 companies. In many firms, they collectively control 20 to 25% of voting power. This is ownership at systemic scale. They don't need to coordinate. They don't need to intervene aggressively. Their presence alone reshapes incentives. Voting power is where passive ownership becomes consequential. Every year, Vanguard and BlackRock vote on board appointments, executive compensation, mergers and acquisitions, governance standards, shareholder proposals. While they rarely lead activist campaigns, their votes often decide outcomes. This has transformed corporate governance. Companies increasingly tailor decisions to long-term index inclusion, ESG and governance frameworks, regulatory alignment, systemic risk tolerance. Executives understand that displeasing large passive holders can affect capital access and reputation. This influence is quiet, continuous, and normalized. As Vanguard and BlackRock grew, so did scrutiny. Critics raised several concerns. One of the most debated concerns surrounding Vanguard and BlackRock is the concept of common ownership. Common ownership occurs when the same large shareholders own significant stakes in competing firms within the same industry. For example, when an asset manager is a top shareholder in multiple airlines, banks, or pharmaceutical companies, those firms may face weaker incentives to aggressively compete. Academic studies have suggested that common ownership can lead to higher prices, reduced competition, lower innovation, more stable but less dynamic markets. The argument is not that asset managers coordinate behavior, but that incentives subtly change when competitors share the same owners. Executives may prioritize industry stability over market share. Risk-taking may decline. Competition becomes quieter. This debate remains unresolved, but it highlights how ownership structure can influence outcomes even without direct intervention. The firms themselves argue they are agents, not principals, managing money on behalf of others. That distinction may matter legally, but structurally their footprint is undeniable. The most important thing to understand is that Vanguard and BlackRock do not grow because they are aggressive. They grow because the system feeds them. Retirement systems expand. Passive investing outperforms net of fees. Institutional capital seeks scale and safety. Regulation favors large, diversified players. Every demographic trend points toward more passive ownership, not less. Unless the structure of capital markets changes, their influence will continue to expand automatically. The key to their influence is index funds. Index funds don't pick winners. They buy everything. When money flows into an index fund, it automatically buys shares across the entire market. Ownership becomes concentrated. Voting rights accumulate. This is what makes them different. They are not short-term actors, they are structural owners. Here's the paradox. Vanguard and BlackRock don't manage day-to-day operations, don't set prices, don't directly intervene in strategy, but they do vote. They vote on board appointments, executive compensation, mergers, governance standards. This creates a new form of influence, systemic, indirect, and normalized. No single vote changes everything, but millions of votes aggregated over time quietly shape incentives. As ownership concentrated, corporate governance changed. Executives no longer answer primarily to individual shareholders, activist investors. They increasingly answer to large institutional holders, governance frameworks, long-term risk models. This has consequences. Firms optimize for index inclusion, stability, regulatory alignment, risk minimization, not necessarily innovation or competition. Critics argue this dampens dynamism. Defenders argue it stabilizes capitalism. Both may be true. BlackRock's influence extends beyond ownership. Its risk management platform, Aladdin, is used by banks, pension funds, insurers, central banks. Aladdin analyzes trillions in assets daily. This gives BlackRock unparalleled visibility into global risk, deep integration into financial plumbing, advisory access during crises. During stress events, BlackRock is often consulted, not regulated. That doesn't make it a ruler, but it does make it indispensable. Vanguard's power is different. It doesn't lobby loudly. It doesn't market aggressively. It doesn't advise governments. It simply absorbs capital. As long as the retirement systems grow, passive investing dominates. Fees matter. Vanguard's ownership share increases automatically. This is power without intention, influence without ambition, and that may be the most durable form of all. During financial crises, the role of asset managers grows. Governments need liquidity, market stabilization, execution capacity. In 2008 and 2020, BlackRock helped design and execute emergency programs. Asset managers became transmission mechanisms for policy. This blurred lines between public authority, private institutions, not through takeovers, but through necessity. This structure lowers costs for investors, increases market stability, reduces speculation, but it also concentrates voting power, reduces competitive pressure, embeds systemic risk. The system didn't choose this outcome. It drifted into it. Vanguard and BlackRock didn't conquer the market. They were built by it, by demographics, retirement systems, fee pressure, globalization, financialization. They are not an anomaly. They are the logical result of modern capital markets. When people ask who owns everything, they're usually asking the wrong question. The better question is who sits at the center of ownership and what incentives shape their decisions. If you want to understand how the global financial system actually works, not the simplified version, but the real institutional architecture behind it, this channel breaks it down in a clear and structured way. Subscribe if you want to stay ahead of the shifts most people won't recognize until the consequences are already unavoidable.